If you've been watching the markets lately, it probably feels like mining stocks are finished, beaten down, forgotten, and left for dead by investors chasing tech, AI, and momentum plays. Prices are volatile, sentiment is weak, and headlines keep pushing fear about China, interest rates, and global demand. But history shows something very important. Some of the biggest gains in the stock market are made when an entire sector is ignored. That's exactly where mining stocks sit right now, and today we're going to talk about why 3 specific mining stocks still have real hope, not hype, not speculation, but fundamental reasons that could matter over the next several years. This is not about quick flips or overnight riches. This is about patience, cycles, and understanding where the world is actually heading. Let's start with the big picture first, because mining stocks don't move in isolation. They move with commodities, and commodities move with global demand, supply constraints, inflation, and geopolitics. Over the last decade, the world underinvested massively in mining. Companies cut exploration budgets, delayed new projects, and focused on survival instead of growth. At the same time, governments around the world are now pushing electrification, renewable energy, infrastructure spending, and reindustrialization. All of that requires metals, a lot of metals. Copper, gold, iron ore, lithium, and other critical resources are not optional for this transition, they are essential. You can't build electric vehicles, power grids, data centers, or modern infrastructure without them. That disconnect between future demand and current supply is where opportunity starts to form. The first stock worth talking about is Freeport-McMoRan. This company is often called a pure play on copper, and there's a good reason for that. Copper is one of the most important metals in the modern economy. It's used in electrical wiring, electric vehicles, renewable energy systems, and industrial machinery. As the world electrifies, copper demand doesn't just increase slightly, it accelerates. The challenge is that copper supply is not easy to expand. New mines take years, sometimes decades, to permit, develop, and bring online. Grades are declining, costs are rising, and political risks are increasing in many mining regions. Freeport-McMoRan owns some of the most valuable copper assets in the world, including large-scale, long-life mines. What gives this company hope is not just its resources, but its balance sheet discipline. Over the past few years, Freeport has focused on reducing debt, improving cash flow, and returning capital to shareholders. Even in weaker commodity environments, it has shown the ability to stay profitable and generate free cash flow. When copper prices rise, leverage works in the company's favor. A relatively small increase in copper prices can lead to a disproportionately large increase in earnings. That's why long-term investors keep this stock on their radar even during downturns. Another important factor is that copper is increasingly viewed as a strategic metal. Governments want secure supply chains. That creates a tailwind for established producers with existing infrastructure. Freeport is not a speculative junior miner hoping to find something underground. It already has proven reserves, operating mines, and global scale. That doesn't mean the stock can't be volatile, it absolutely can. But volatility is often the price of long-term opportunity. Now let's shift to gold, a metal that many people think of as boring or outdated, but history keeps proving otherwise. The second stock with real hope is Barrick Gold. Gold plays a very different role compared to industrial metals. It's not about electrification or infrastructure, it's about trust, currency stability, and protection against uncertainty. When inflation is high, when debt levels rise, and when confidence in fiat currencies weakens, gold tends to regain attention. Barrick Gold is one of the largest and most respected gold miners in the world. What sets it apart is scale, geographic diversification, and operational expertise. Barrick operates some of the highest quality gold assets globally, and it has spent years optimizing costs and improving efficiency. In a sector known for poor capital allocation in the past, Barrick has taken steps to be more disciplined. That matters more than many investors realize. The reason Barrick still has hope is not just about gold prices going higher. It's about margins and stability. When gold prices remain elevated, even if they don't skyrocket, Barrick can generate strong free cash flow. That cash flow can be used to pay dividends, reduce debt, and invest selectively in future projects. In uncertain macroeconomic environments, investors often rotate back into gold producers because they offer exposure to gold prices with potential income. Central banks around the world have also been increasing their gold reserves, quietly but consistently. That long-term demand supports the gold market in ways that short-term traders often ignore. There's also a psychological aspect. When markets become unstable, investors look for assets that have survived every financial system in history. Gold fits that description. Barrick, as a major producer, becomes a proxy for that belief. It may not be exciting during bull markets in tech, but during periods of stress, it often regains relevance quickly. The third stock is more diversified and represents the backbone of global industry. That company is Rio Tinto. Rio Tinto is not just a mining company, it's a global resource powerhouse. It produces iron ore, aluminum, copper, and other essential materials that modern civilization depends on. Iron ore alone is critical for steel production, and steel is the foundation of buildings, bridges, transportation, and infrastructure worldwide. What gives Rio Tinto hope is its scale, efficiency, and strategic positioning. The company owns some of the lowest cost, highest quality iron ore assets in the world. That means even when prices fall, Rio Tinto can remain profitable while weaker competitors struggle or shut down operations. Cost leadership is one of the most powerful advantages in any cyclical industry, and mining is as cyclical as it gets. Rio Tinto has also been focusing on future-facing commodities, including copper and materials used in batteries and renewable energy systems. This diversification reduces reliance on any single commodity cycle. On top of that, the company has a strong history of returning capital to shareholders through dividends. For long-term investors, that income component can be extremely attractive, especially in uncertain markets. Another important point is geopolitics. As countries push for domestic manufacturing and infrastructure investment, demand for raw materials doesn't disappear, it shifts. Even if one region slows down, another often picks up the slack. Rio Tinto's global footprint allows it to benefit from these shifts more effectively than smaller, region-specific miners. So why do these three stocks still have hope when so many investors have written off mining altogether? The answer lies in cycles. Commodities move in long cycles driven by supply and demand imbalances. When prices are high, companies overinvest. When prices fall, investment collapses. We are currently in a period where years of underinvestment are colliding with rising structural demand. That doesn't guarantee immediate gains, but it sets the stage for potential upside over time. Another key factor is valuation. Many mining stocks are trading at levels that already price in a lot of bad news. Slow growth, weak demand, and economic uncertainty are not new concerns, they're already reflected in prices. When expectations are low, companies don't need perfection to outperform. They just need conditions to be slightly better than feared. It's also important to understand that mining stocks reward patience. These are not stocks you buy expecting instant gratification. They are stocks you hold through volatility, reinvest dividends, and wait for the cycle to turn. Historically, when mining stocks move, they can move fast and aggressively. Investors who wait for confirmation often miss a large portion of the upside. Of course, risks remain. Commodity prices can stay low longer than expected. Political risks, environmental regulations, and operational challenges can impact performance. That's why focusing on quality matters. Companies with strong balance sheets, world-class assets, and disciplined management have a much better chance of surviving downturns and thriving when conditions improve. The market loves stories, trends, and excitement, but it also has a habit of forgetting what truly powers the global economy. Metals and resources are not optional. They are foundational. Whether it's building cities, electrifying transportation, or protecting wealth during uncertain times, mining companies sit quietly at the center of it all. These three mining stocks are not guarantees, and they're not recommendations. They are examples of why writing off an entire sector can be a mistake. Sometimes, hope in the market doesn't come from flashy headlines, but from understanding cycles, fundamentals, and human behavior. When fear is high and attention is elsewhere, that's often where opportunity begins. If you want more deep market breakdowns like this, long-term thinking instead of short-term noise, and honest discussions about where money flows over time, make sure to stay connected with Stock Predictor, because the best opportunities are often found where few are willing to look.